At 5 p.m. today, a new banking rule went live in the United States. Most people won't notice, but it is already quietly reshaping global capital flows. This is not speculation. Markets are responding, and investors are moving quickly behind the scenes. What you're about to see will reveal how this single regulatory change can ripple across continents, impacting banks, businesses, and everyday investors. Stay with me, because understanding this now could give you a significant advantage. The banking rule in question focuses on capital reserves and risk management. It requires U.S. banks to hold a higher percentage of secured reserves before issuing certain loans. On the surface, it looks like a minor compliance adjustment. But in practice, it limits liquidity, slows lending, and changes how capital moves internationally. Even banks in Europe and Asia are monitoring this rule closely. A subtle adjustment in U.S. banking regulations can cause global tremors, affecting economies far beyond American borders. Let's start in the U.S. Banks with large corporate portfolios will need to adjust overnight. Loans may become more selective. Interest rates on certain products may rise, and liquidity for riskier assets could shrink. This means borrowing costs for businesses could go up within days. For multinational corporations, the timing of cash flows and debt issuance suddenly becomes critical. Analysts already expect that some mid-tier banks may restructure lending programs to comply without breaking capital thresholds. But the impact doesn't stop in the U.S. Global investors watch U.S. banking rules because they dictate capital availability worldwide. In Asia, banks dependent on U.S. credit lines may adjust their own lending policies. Europe could see currency fluctuations as capital moves toward safer U.S. assets. Countries with emerging markets are particularly vulnerable. A small, loose change can tighten access to dollars and credit. The ripple effect may be subtle at first, but over weeks it can significantly alter market behavior. To understand the stakes, consider history. In 2008, a seemingly small regulation change in U.S. banking practices triggered global liquidity problems, affecting millions worldwide. Banks tightened lending, investors pulled capital, and even foreign governments scrambled to protect their markets. Fast forward to today. The U.S. financial system is more resilient, but rules still have massive international influence. Learning from history allows us to anticipate which sectors and regions are most at risk before the broader market reacts. Who benefits from this rule? Large institutions with diversified portfolios. Hedge funds and multinational corporations can capitalize quietly, while smaller investors feel the pressure. Who loses? Regional banks, small businesses, and countries heavily dependent on U.S. lending are most exposed. Timing and positioning are everything. Early awareness allows you to avoid losses and spot opportunities that the average investor misses. Let's break down the mechanics. When U.S. banks hold more capital, there's less money available for international loans. Money that would have flowed to Asia, Latin America, or Europe may remain in domestic accounts, seeking safety. This causes shifts in currency strength, interest rates, and investment patterns globally. Countries heavily reliant on dollar liquidity must adjust quickly or risk market instability. Investors in these regions must read signals carefully to protect their capital and profit strategically. Take a hypothetical emerging market bank in Southeast Asia. A sudden reduction in U.S. lending forces the bank to delay corporate loans. Local businesses struggle to secure funding, which affects production, hiring, and exports. Investors notice the slowdown, and stock prices for key companies drop. Meanwhile, multinational corporations with alternative access to capital quietly increase market share. Understanding these patterns is exactly what Global Capital Brief is built to explain. Analysts say, even minor adjustments in U.S. banking regulations can cause global portfolio shifts. The Fed, Treasury, and large financial institutions monitor these changes daily. Being late to respond could cost investors millions, while early movers gain quietly. Knowledge is your most valuable asset in times like these. Why should you care if you're not a banker? Your investments, savings, and even daily spending can be affected. Interest rates, mortgage costs, stock prices, and international trade are all tied to U.S. liquidity and lending behavior. Understanding this early gives you an edge over the market, even if you're just a retail investor. Small knowledge gaps can translate into large financial consequences. Here's what you can do today. 1. Monitor U.S. banking news and regulatory updates. 2. Track interest rate movements and liquidity indicators. 3. Pay attention to currency and capital flow trends, especially in Asia and Europe. 4. Stay prepared for market volatility. Small U.S. rules often have major global consequences. 5. Be strategic. Early awareness is a competitive advantage. Now we dive deeper. How Trump-era policies, the Federal Reserve, and hidden market opportunities interact with this rule. Understanding this connection could give you an edge in global financial strategy. Even though this rule is new, its effects are amplified by policies enacted during the Trump administration. Corporate tax changes, deregulation moves, and trade agreements all shaped the U.S. banking system's response. These policies influence how banks hold reserves and lend internationally. For example, some large U.S. banks still benefit from deregulation incentives, giving them more flexibility than smaller competitors. This is why market insiders closely monitor both current rules and historical policy context. The two work together to shape opportunities. Next, the Federal Reserve. The Fed doesn't just set interest rates, it controls liquidity, market signals, and lending conditions. When combined with the new banking rule, the Fed's policies determine 1. How fast money moves internationally. 2. Which banks are best positioned to profit. 3. The timing of market reactions. Analysts call this a silent multiplier effect. Small changes in policy can create massive global consequences. Understanding this interaction is key to anticipating market shifts. So, where are the opportunities? Hedge funds, multinational corporations, and sophisticated investors watch for mispriced risk. Regions dependent on used credit may temporarily undervalue assets, creating a window for strategic investment. Early movers can buy undervalued stocks in emerging markets, hedge currency exposure, reallocate capital to banks with strong reserve positions. The key is timing and insight. The average investor rarely notices until markets have already moved. Let's look at Asia first. When U.S. banks tighten lending, capital inflows into Southeast Asia slow down. Local banks may increase interest rates or tighten corporate loans. Investors can anticipate short-term volatility and identify undervalued opportunities in tech, manufacturing, and export-driven companies. In Europe, currency markets react differently. Euros may strengthen temporarily as dollars tighten, affecting trade and commodity prices. Understanding these regional differences is crucial to making informed decisions. Beyond obvious impacts, there are hidden financial dynamics at play. Some U.S. banks have off-balance sheet arrangements or international partnerships that allow them to move money discreetly. Hedge funds and private equity firms often exploit these flows before mainstream investors even notice. This is why monitoring news alone is not enough. You need insight into capital behavior patterns and timing signals. Part of staying ahead is managing risk. Investors should diversify across stable U.S. banks, emerging markets with strong fundamentals, multi-currency exposure. Small adjustments in your portfolio can shield against volatility while positioning for profit. Ignoring these dynamics could leave you exposed to sudden changes in interest rates, stock valuations, or currency shifts. Looking ahead, analysts predict several possible outcomes. Continued tightening of credit by mid-tier banks. Slow but steady capital realignment toward resilient institutions. Temporary undervaluation in emerging markets. These scenarios create both risk and opportunity. Being informed and proactive allows investors to capitalize on short-term inefficiencies while avoiding losses. Let's summarize what you need to remember. 1. Timing matters. Early awareness beats late reaction. 2. Capital flow patterns indicate hidden opportunities. 3. Policy context, Trump era, and Fed decisions amplify effects. 4. Global perspective. Markets in Asia and Europe respond differently. 5. Risk management. Diversify to stay protected while seeking gains. Understanding this banking rule is just the beginning. Global finance moves faster than most people realize, and staying informed is the key to success. Subscribe to Global Capital Brief to stay ahead of the market, uncover hidden opportunities, and see how global capital really moves. Knowledge is power, and in this game, early knowledge is profit.